What a week in markets, and not in a good sense. In the last 7 days, we have seen events in crypto reminiscent of some of the worst blunders of 2022, and equities had their most challenging week since the thick of tariff tantrums back in April of this year. This is clearly represented in the Fear and Greed Index, which got into extreme fear for both equities and crypto this week, and that's the first time we have seen that read in over 6 months. Also, sentiment online is terrible, absolutely in the toilet, with everyone seemingly turning bearish. But I have some good news. This extreme fear read is not what we typically see before markets crash, especially when the S&P 500 is sitting just 2% away from all-time highs. So that leaves us with two possible outcomes. Either this indicator is completely broken and we shouldn't trust it anymore, or we should expect a rebound in Q4. I've got a whole lot more to say about that, so let's get right into it to review the charts and the macro for stocks, commodities, and crypto. Let's go. This isn't financial advice. Past results are not indicative of future performance. Do your own research. Welcome back to the Trading Apologist. My name is Tom, and I hope you all held up okay this week. Me personally, I got really great at circular breathing. Before we dive in, likes, comments, and subscribes, they're very much appreciated. They really do help the channel in these early days, and they mean a lot to me personally. So, it's clearly been a challenging week in markets, and there is a lot to unpack, including the reasons for optimism as we head into the remainder of Q4. As I mentioned on Monday, the turbulence that we're seeing shouldn't really phase folks in longer term positions, assuming you are positioned appropriately, but it is something to work around if you are swing trading, particularly with options. The good news is that we closed the week with a green weekly candle on the S&P 500, reclaiming more than half of last week's pullback, and we formed a clean inside bar, which generally signals indecision or consolidation. A pause, not necessarily a breakdown. So in other words, the markets are catching their breath. Seasonally, this kind of choppiness fits in right with what we have been discussing for weeks. October corrections are common, especially in post-election years, which have a positive August, and the third year of bull runs. I still view this as a healthy temporary pullback rather than a trend reversal. If we look at this chart, historically, when Q4 finishes positive, it averages about a 7% gain with a 5% drawdown along the way. Right now, we're down about 3% from the quarter's peak. So we're right in that sweet spot for a normal setup before a year-end rally, and often October lows set the low for the remainder of the year. That said, sentiment has clearly shifted. There's no shortage of headlines weighing on risk appetite. We have China tariff tensions, of course, renewed banking concerns, and the US government shutdown that could now stretch well into November. Some estimates are now pointing at upwards of 40 days. Add to that last Friday's crypto flash crash, and you can see why traders are obviously skittish. Events like that crypto crash, especially near the traditional end of a 4-year cycle when we're getting to that 1,064 days, tend to make everybody more cautious. Even if institutional participation is now a stabilizing force in the background for crypto, that timing near the end of a 4-year cycle is enough to push a meaningful percentage of crypto participants to the sidelines that could make an impact. We also saw that caution spill into equities, with failed breakouts on names like QUBT and HIMS, sharp rejections that signal a temporary pause in speculative momentum. When strong mid-cap names and laggards alike get rejected from clear breakout setups, it usually means that we're entering a short-term, let's call it a repair phase, where markets consolidate in tightening ranges before the next move. A good rule of thumb that I like to use is that the sharper the pullback, the longer the time needed for consolidation. And the drop in these equities that we saw today is not too dissimilar from the crypto drop last Friday. Now, the wild card in all of this is gold, which sold off nearly 5% after an 8-week historic run. That large pullback that we saw today indicates profit taking and likely marks the start of a cooling phase. We should eventually see those flows from profits rotate into other assets unless we see a full-blown cash is king style panic, which seems unlikely given the ongoing debasement and inflation concerns with that flight to hard assets. Big picture, I am still watching the 20 weekly moving average around 6,400 points on the S&P 500 as a potential retest zone. If we reach that level, I'll look to add more aggressively, as that setup historically precedes strong year-end rallies. To me, this really feels like a pause, not a peak. Yes, we're in chop and some names have dropped substantially, but this is the kind of correction that often sets the stage for the next push higher. So with all that said, let's dive into the charts, where we'll really focus on key support levels today and a few new names with interesting setups. Okay, starting here on the S&P 500, and you can see that we reclaimed over 50% of the drop from the end of last week. And we have that inside bar, bit of a doji, I suppose, with the wicks on either end, which is just indicating that indecision, that pause in trend, and most likely more tightening and chop in the week ahead. If we do drop further, we're still watching what I called out in the macro overview, the 20 weekly, which is this pink line right here, currently coming in at about 6,400. Obviously, as we move through time, that is going to continue drifting up, and we might, if we come into this in a couple weeks' time, be closer to 6,450 or somewhere around there. If we do switch over to the NASDAQ, you can see that we have a very similar setup here, and I'll just turn off the Confluence model cloud so we can focus on the price action. And same thing in terms of an inside bar, very similar candle showing that big range, but closed a little bit stronger than the S&P 500. And the semiconductor space has actually been showing some more strength than other sectors. So to illustrate that, I'll just switch over here to SMH for the semiconductor space, which actually had a green day today and has recovered much better than the rest of the market. If we're comparing this just compared to the indices in terms of last Friday's drop, we actually made a higher high compared to last Friday, not compared to 2 weeks ago, but not an all-time high, but we made a higher high compared to last Friday just on Thursday. And today we had a similar doji showing some indecision there in the trend today, but a green bar nonetheless to close the week. So it's great that we are seeing continued strength in semiconductors broadly. Okay, instead of starting with gold and Bitcoin, I am going to start with some of the new charts here at the top of the video. And the first one here, CLF, we actually covered on Monday, but the rest are all new. And this one, I'm still looking for an entry. And we had the inverse head and shoulder breakout targeting about $19. I'm hoping for a pullback and a retest of that neckline breakout at about $12.30. It looks like we're maybe just starting to roll over. We also have this bit of downtrending overhead resistance that we are bumping up against that has been playing resistance for years since this top all the way back in April of 22. So you can see how overhead resistance comes into play time and time again on names like this. So just keeping my eyes on this one right now for a potential good entry. Okay, next one on the list is Amazon, and I know what you might be thinking. We're normally looking for disruption and innovation. What are you doing looking at Amazon? Well, Amazon to me is a value play. If we go and look at the weekly, in terms of our 2021 highs, if we measure where we are compared to those, we are only 13% above 2021 highs currently. And I would argue that Amazon is more than 13% more valuable than in 2021, or has increased in value more than 13%. There has been drag on this stock. It has not rebounded from the April lows like some of the other tech names. And the setup right now reminds me of Google in the spring, where it was undervalued as a business compared to the rest of the tech sector, or the Mag 7. And the drag on Amazon right now, just going back to the daily, has been largely tied to massive CapEx spend, data centers, automation, robotics that they have not seen ROI from yet. And I just set my first limit order at $206. I think between 200 to 206, we should see a bounce, even though, we just broke down from the 200-day moving average, slightly broke below this previous low. If we look on the 4-hour, you can actually see how we broke down a little bit more below that previous low. So yes, it doesn't look like the most positive chart yet, but for me, this is a little bit longer term of a play that I would be holding for the next couple of years to see if they can really realize some of those efficiencies, cost savings, which means reduction of headcount from robotics and automation, to carry through onto the chart. And if we get back to this previous peak right here, around around the $200 mark. I was going to say these peaks right here, around 190. That would be a very strong zone for support. So if we get back down there, I will be adding a lot more to my position. And since this is a longer term play, this is scaling in. It's going in with about 10% of my position here, maybe another 20% to get me 30% all in. And then if we get all the way down to 190, then I would add probably another 40% of my position. So I'm 70% deployed. And then I leave just a little bit more in case we dip irrationally and would deploy the rest on the rebound. But scaling into longer term holds is always the way to go. Think of it as a pyramid. You want to pyramid into your positions like this. And then on the flip side, as things are moving up, you want to pyramid out of your positions. So you're selling a little bit, then a little more, and then the most as we're getting to those peaks. Okay, looking to PayPal, this is one where I just deployed a little bit of a position as we dipped down yesterday on Thursday, picking up some leaps for January of 2027. And this one is not the highest conviction play for me in terms of it being a large portion of my portfolio. This would be about a 1 to 2% of my portfolio size position. But if we look at this on the weekly and we look at just this higher high and this higher low that we set on the 7th of April, now it appears that we might be recovering from that, and we have this strong area of support that I'm looking to just based on these previous highs as we were recovering. So we do have earnings coming up. If we drop on earnings, I might have to reassess the thesis here, but I'm looking for some kind of recovery here in PayPal. Okay, next play, which I have not gotten into a position on yet, but is Block or XYZ. And this has been in almost a 2-year plus consolidation pattern, just chopping back and forth. And it looked like we were making higher lows, higher highs. Then we dropped back down in April of this year during the tariff tantrums. And now we've recovered and we've been in about a 2-month consolidation pattern. And I'm eyeing this for an entry, which we can see more clearly on the daily. And you can just see that very tight range that we have been in between $71 on the underside and $82 on the overside, so $10 range. And I just started looking at this a few days ago. I missed this entry on Tuesday of this week where we dipped down. It just shot up too quickly. Almost got an entry again today. I have that alert set there at 73.22. So if we get back down to the bottom end of the range, I would be keen to take a little position, and I'm just looking at this flag and the 100% extension to potentially get us up to that $110 level, surpassing these previous highs. So in terms of a swing trade, I'm just looking at it for that short-term play that would run for a few months, I would imagine, depending on when this breaks out, between January and February of next year. Unless this just keeps consolidating for months, then that's a different story, and we have to adjust our time projections based on when this does actually break the range. Okay, getting back to our normal rhythm, we'll start with the dollar, which really just looks like it put in another higher low today. In terms of this recovery, we had a green candle. So let's see if we can break through that range at 99. That would be a big test for the dollar and a sign of strength for some near-term recovery. Again, on the macro, we're thinking the dollar is going to break down more, but that doesn't mean that it can't move really, all the way up to 103, perhaps even higher, before continuing that trajectory to the downside. We are squeezing on the confluence model bands, so that's indicating that some kind of volatility is going to be coming into the dollar within the next couple of months here, or by early next year. Okay, if we look to gold, you can see that massive rejection today. The candle actually did close a little less bearish than it was. A couple hours before the close, we were all the way down below the low of yesterday's candle. That would have been a full bearish engulfing candle. We were able to recover a bit to just make this an inside bar with those wicks on either end. But still, this is one of the biggest sell-offs gold has had in this 8-week rally up, and we should take note of that. That's exactly what got me to call this as being the top of the last rally and the start of a period of consolidation, was that massive wick to the upside and the sell pressure that we saw kick in that was just way bigger than anything we had seen in history. I mean, really, these candles on the run up, whenever they exceed the scale of previous daily candles, it's telling you that that is not a sustainable move for the long term. And we've seen the same thing play out here where, okay, we had a more aggressive breakout of the range, which is okay to see. You want to see that follow through when you break out of a consolidation range. But then our candles were roughly similar in size, and the last 4 days were about double the size for each candle, just massive moves. So let's see what happens for gold. I would like to see it go into a period of consolidation. Is gold a natural short? I don't know. I think that's a very risky play. It could pull back, 15%, sure. But I would say most likely it consolidates because gold has had to catch up in terms of its monetary value. But I could see this consolidating again and then perhaps pursuing another leg higher. Okay, starting here with Bitcoin, where it appears maybe we've made a bit of a double bottom with this wick down to 103. That said, we have to take this wick with a grain of salt because with the massive depegging event, this wasn't equal on all exchanges. Some went down to 98K, some only went to 107. Some really stopped at 110. So when that happens, I don't want to say discount this wick from our TA, but we have to note it as an anomaly. Some people even like to add notes to their charts. And I've picked this particular chart from crypto.com because it is an average or an approximation of an average between all those various prices that were logged on different exchanges. So if you want to be really precise, you could go across the 5 major exchanges, note what the low was, figure out what the average is, and then you could draw a signal on your chart off of where you should base that. Now on the 4-hour, we are seemingly finding some resistance at the 200-day moving average now that we've broken underneath it. And once we get into the lower band on the Confluence Model Cloud, we know that even if we recover, we most often see 2 or 3 swings down, which could get us to that 95 to 98K range before recovering on Bitcoin. But let's go back to the daily and look at our underside support. And you know what, really quickly, let's just draw our overhead resistance. So if we draw a trend line down from the all-time highs, you can see a very clear overhead resistance there. And we can even draw a secondary one that connects our steeper decline here and the local price action. And that will just give you a sign of an early bit of recovery, but really this upper trend line here would be our major overhead resistance that we need to get above to note a recovery. But on the support end of things, if we are really zooming out, I would go all the way back to the yen carry trade low back in August of last year, and that's April. Let's go back further. Haha. All right, now we're cooking. All right, here's the yen carry trade low. If we connect that through the tariff lows there in April of this year, we have 1, 2, 3 touch points established as a valid trend line. And if we drop down into this, this is where we would need to see support also coming in, incidentally, around 95K currently. If we were to drop a trend line like this, that to me would be a sign of the broader bull market breaking down. You can call that earlier. But this would be real confirmation. A lot of people have been saying, and I said this on Monday, I don't really want to see multiple daily candle closes below 108, which corresponds to these previous highs, the middle of this consolidation range. So there's already some weakness showing. But the question is this just going to chop around and correct a bit longer and then recover? Or is this foreshadowing more pain to come? If we are looking at the bull market for the last couple of years since the 2022 low, we have gotten below the 200-day moving average on our other periods of consolidation. So this is not totally abnormal. We even dipped below it here at the end of 2023 when we got out of the bear market, broke above. We got below the 200-day moving average for, what was that? August through October, almost 2 months that we were underneath it there before we broke out. And here, I mean, this was almost 3 months that we were underneath it. And here it was about a month and a half that we were underneath that. So it's not uncommon, but as I mentioned in the intro, this was a massive event last Friday, and we shouldn't be surprised for the recovery to take some time. Obviously, the quicker the recovery, the stronger a sign. As we move on in a bull market, you want to see corrections recover faster and faster. It's telling you that hype, buying momentum, excitement is maintaining and increasing. But we could see a couple of weeks, maybe we test this trend line under that 200-day moving average, and then we could break back above it. A scenario like that is very possible, and we could just see time-based capitulation where participants, through just time and fear or boredom, get shaken out of the market before it continues on the next leg higher. Okay, moving on to Solana, and we're going to go to my messy chart today. I haven't brought back the messy chart in a while. I'll at least turn off the Confluence model to spare you guys a little bit something. But really, on the daily, this trend line that has played support for us since April, I want to see that hold. I would be more concerned for Solana underneath that, which would also be underneath the 200-day moving average and would get us into the lower band of the Confluence model on the daily time frame. But the one thing I wanted to bring up that is so fascinating to me, if you see this diagonal yellow line, this has been a trend line that has been support and resistance for us, not to the dollar and cent, but it has played a role in this market since January of 2024, being support. We bounced off it for support once before chopping around, then resistance, support again, resistance, not so much support there on the Israel-Iran conflict. But now we still seem to interact in a way with that trend line that gives it some level of significance where you see those candle closes. And I guess in terms of the near-term analysis, there really isn't a broader point to that outside of me just being amazed at how long these diagonal lines can influence the price action in some way. Obviously, that weakens over time, but it's still very much in play. So we have that clear underside support in terms of overhead resistance. We have this minor downtrend here that breaking above would be a first sign of recovery. And then we have our major overhead resistance from our local high that we can connect through like that. And that would be what we really want to get over. But if we go back to the daily, broadly speaking, you could argue that between this underside support line, which I'll make brighter, and this major overhead resistance, which we can map out from our highs in January, that we are now just in a massive symmetrical triangle. And we could tighten up in this range 4 months through early next year before resolving one way or the other. And I know we have the ETFs coming, so maybe that helps get us off of this underside support a little bit. But if Bitcoin takes its time consolidating under the 200-day moving average, is there a world in which this could just tighten up before breaking out meaningfully? And would people get shaken out of their positions only to see crypto run again early next year. That's absolutely a possibility, and we have to entertain and keep our mind open to all these scenarios. Okay, MicroStrategy, starting on the weekly, where you can see, we broke down from the weekly RSI support, backtested it for resistance, are continuing to break down. And it really feels, although we are finding some near-term support at 280, that we are going to eventually intersect this trend line here, which would be landing, depending on when that happens, between 240 and 250. If Bitcoin has a near-term breakdown to that 95 to 98K range, I think we would get there sooner rather than later. And we would want to see that play support. Just like we were talking about major underside support for Bitcoin and Solana, MicroStrategy breaking down from this level would not be a good sign for the next several months. And we would most likely see lower prices if that trend line gives way. If we are just going into the daily, the one thing I will say on the positive side for the daily, we've printed mean reversion dots. We can obviously drop lower on mean reversion. We're finding support at an area at around 35 where MicroStrategy often bounces on the daily for mean reversion. And we'll go into the 4-hour too. But we are still, broadly speaking, printing lower highs, lower highs, lower highs, lower lows, lower lows, lower lows. So the structure hasn't shifted. We did get a decent bounce today from this area of support, but let's see what this does next week. And that next support is not too far away. And on the 4-hour, the good thing on the 4-hour is that we are getting some decent mean reversion, 2 standard deviations below the mean, which is normally anything beyond 2 standard deviations is a zone that really makes sense to get in. You can see that bounce today pronounced a bit more dramatically on the 4-hour. Pre-market, we got all the way down to 270. We closed at 291. So a good little recovery there, but MicroStrategy still has more proving to do. Okay, Tesla is still range bound, and it does feel like it wants to push to the upside past 245. And if it can get above 250, it clears the way to really break out to 500 or higher potentially. I know this has been overextended and it's run, but if we look at the 4-hour, our bands are starting to squeeze. It just indicates that a volatile move is incoming. And since we have mean reversion to the downside on the 4-hour, and the daily now has reset a little bit in terms of the RSI being neutral, mean reversion could obviously come down a bit more, but we're in that upper band of the confluence model cloud, which is influencing me to think that this is a move more reminiscent of December of 2024, rather than a quick move up and correction like we saw in July of 24, where it was just one swing up and a correction. It really seems to be forming that flag and wanting to push higher. So keep your eyes on this, particularly on the 4-hour chart, to see what we start doing in these bands. And let me remove the fib levels just so you can see it a bit more clearly. And you can see that compression taking place. So, this isn't going to probably happen right away on Monday, but we do have earnings coming up for Tesla. Is it the 20th or 22nd? 22nd, Wednesday of next week. So if I was a betting man, I would say earnings are going to be the catalyst for some kind of volatility, and we'll see this resolve to the upside or the downside. Historically, earnings have been negative more often than they've been positive, but I'm going to say earnings are going to be positive this time. The chart is just slightly skewed that way. So let's hope I'm right. Okay, in terms of other names that are performing positively while the rest of the market is dragging, Celsius has been one of the more positive names in my portfolio the last 2 weeks. And if you recall during April, where was April here? This was the middle of tariff tantrums. Celsius was the only thing going up in my portfolio. So it's actually been a good hedge in turbulent times. And I didn't think this next run would be quite as positive, but this weekly cup and handle that we have, or I guess we're viewing it here on the daily, is pointing, if this confirms, and now we've closed a daily and a weekly candle above the breakout zone, which last week we couldn't do, we just wicked above, seems to be confirming this target of $104 for Celsius. So this could take a while to get there. It's not going to go up in a straight line. I have some shares that I now bought at a little bit at 52, a little bit more at this breakout. And then I got into some leaps for, I want to say January 2027, if memory serves, that give me some time for this scenario to play out. So those are already nicely in profit, and obviously they'll do much better if this continues on the way to its price target. Okay, one other one that I got into some leaps on is Deckers, because we've been oversold on the 4-hour. We're getting some bullish divergence now on the RSI, and it's been getting great support here at that mid $90 level and has just been in this tightening range. Things were looking bearish for them, but with tariffs resolving a bit and a very positive earnings call that they had back here in July, the stock really popped and then chopped around a little bit and has dropped back down. So we have earnings coming up as well for this on the 23rd of October, the day after Tesla. And these calls I got into, even though it hasn't recovered much, are also already in a profit over 18%. So options are powerful. And I have the $130 calls out also, I think, to January of 2027. So I don't need this to get to $130, which, is just near the top of this range here. I just need it to get anywhere in this range within the next year, and I can sell it at a profit. But if we're looking at this on the weekly time frame, we've been oversold on the weekly. It should be recovering soon. But I'm really thinking eventually we're going to get out of this phase of consolidation, and we are going to get more meaningfully back up to the all-time highs. So this is definitely one to watch. It's slow moving. It's not exciting. It's got a lot of work to do to recover, but we've been forming a clear base, and assuming this base holds and we don't drop down to $80, which would be the next underside support, and mean reversion on the weekly is giving us an accurate signal, we should expect some recovery. Okay, Hood has been pulling back a little bit, and this was one of the only ones that I was happy to see pull back, because I would love to get more of an entry. And if we are looking at targets to the downside, we did bounce from the Confluence model upper band today, and this thing has just been so resilient. When it looks like it's going to correct, it just keeps going and reclaims levels. But it was a decent, correction from the 252 highs down to 120. What did we get? 125. Doesn't look like much on the chart, but when you map it out, that was an 18% pullback that we saw for Hood. So if you're really aggressive on Hood, 18% might be enough, and maybe we see a bounce there. And if we look to the 4-hour, let's see. Oh, that was also a bounce from the center band on the 4-hour Confluence model. Mean reversion is overextended to the downside. 4-hour RSI is almost reset. So yeah, maybe that was a good entry level for Hood. I've been just looking to 117, this previous consolidation range, or let's say 120 for sake of round numbers. So we got pretty close to that. And one thing I've been finding, because I'm picky with my entries and it has been a hot market, if you're identifying 120 and this gets front run at 123, you're just missing out on it by a few dollars. So sometimes in a market like this, I'm preaching to myself right now, you need to step up your entry just a little bit, be a bit more aggressive to make sure you get those fills. But if this corrects more, I would be a buyer around 120, especially if we get down to the lower end of this range, anywhere near 100. Oh man, I'd be really keen at that point. Okay, looking to coin, which also had a decent pullback and a nice bounce today. And on the bounce this morning, I made the tough decision of selling my calls that I got into down here, which they were up 180% or something already, and now they were only up like 38%. And the reason I did that, which in hindsight, might have been a bad call, but we'll see how it plays out, is because we broke down from the RSI uptrend, and I told myself if this didn't hold, I would exit my calls just to be safe. And we came back up and we're testing that now from the underside. Actually, not quite, but almost. So let's see what this does next week. I might, I locked in some profits, but I might be in a position of having to chase this, but ultimately I wanted to stick to my rules. And every time the daily RSI uptrend has broken down in the last couple of years of price action, it has led to a more meaningful pullback. So it was just one of those instances of, yes, it was uncertain, but I ultimately told myself, hey, you guys stick to your rules. They're no good if you don't stick to them. And, maybe I end up paying for that this time, but the track record would point to the contrary. But if we do look at the 4 hour, obviously the 4 hour, the other thing I was thinking on the 4 hour this morning, we had broken down underneath. So I'm like, is that foreshadowing, more of a breakdown? I don't know. We'll have to see how this plays out. But the bounce was a good sign, but it still has a little bit of work to do for coin to recover. And if there is more weakness in crypto, I imagine this might see slightly lower prices, and then I would get a chance to get back in. Okay, moving on to HIMS, which is one of the ones we mentioned in the intro, and they broke out of a month-long consolidation range where we were getting resistance by the Confluence Model upper band at around that $60 mark. They broke out on news of a new menopause treatment, and then their CEO sold a ton of shares, and he's been getting scrutiny online for his insider selling, and he's been selling in bigger tranches throughout this. I made a detailed post on it on Patreon. I don't know if that's what led to the sell-off or just profit taking, but that just accelerated today, down over 15%, and from the top to the bottom, in 2 days. Let's see, in 2 days, we gained 26.27%. And then in the following 2 days, I guess let's just measure from the high because we gapped down, we lost 23% to the downside. So quite the move in either direction. I was almost considering getting in at $50 because if we go to the 4 hour time frame, $50 had played a ton of support. And then we just broke down from it after hours and now are retesting it from the underside. So this was a dramatic move. And now I'm looking to, let's say, that $47 to $48 area to see if that will play support. And beyond that, really 45 would be the next level. And that's also getting near the 200-day moving average where we've bounced from a couple of times. So if we get down there to the mid 40s next week, I would be a buyer. If you ever want to do short-term trading, there's a lot of volatility in this name. And if you trade on the 1 hour chart, I've found that in periods of chop, this one is just very clean in terms of its signals. And what I mean by signals for entries and exits, we're looking for mean reversion dots that correspond with RSI above 70 to sell, RSI below 30 with mean reversion dots to buy, sell, buy, sell. No, don't quite get the buy there on that one. And we got the buy right there. And then we get another sell signal. And we didn't get the buy here because RSI was not below 70. And then we get the sell. And on the 1 hour, we're just getting a buy signal. So we'll see if that holds. But the clouds are now expanding. And this range, broadly speaking, we have been in, which terrible drawing, but you get the idea of the range, has now expanded to the upside and the downside, indicating more volatility. And if you look at those expanding clouds and you look at the 4 hour, it seems like there is more room to go to the downside until we now hit support. But good one to trade. And honestly, with the volatility, one to think about adding to a pair trade chart. I don't know what the complementary positively correlated asset would be, but good thing to, add into the mix potentially. Okay, looking to QUBT, which was the other name that looked like it was breaking out. We've had this massive symmetrical triangle pattern, a cup and handle pattern in play. And after the breakout, we took a thrust up on the 2nd of October, came back down, back tested the breakout, and had another thrust up earlier this week. And then with the rest of the market, just ended up rejecting, now breaking back within the range and making lower lows. I got out of my calls today because we broke this previous swing low. This I would have still been okay with. This was a sign to get out. There was a bounce midday. RGTI had a bit of recovery, but now I just need this chart to prove to me that it wants to do something, and it appears like there is going to be a bit more consolidation before the quantum space can get a move on again. So I'm going back into the mode of watching it, watching structure, watching the counterparts in the space to see if there is still strength in those names, to see if this as a laggard can finally get a move on. Okay, really briefly, I want to come back to Unity Games, which I'm still in the process of building a longer term position in, which, has already broken out. And I started scaling in at around $35. Not much of a position yet to speak of, but if we look at things on the daily, we are getting a mean reversion dot. This could trickle down a little bit lower. So this previous consolidation range, these previous highs, these are areas I'm watching around $30 to $33. And if we get back down there, then I would be adding more heavily, particularly if we got all the way back down to the 200-day moving average. If that comes up to $30 in a couple weeks time. So, on the 4-hour, it looks like it's printing a bit of a bullish divergence between rising RSI and still falling prices. So keeping my eyes on this one just to see if I can get a little bit more added to my position at lower prices. If we look at the 4-hour, we took swing 1. Now we're in the process of maybe swing 2. Is it going to take a swing 3? I don't know, but the 4-hour is really worth watching on this one if you want to get in, and it seems like it is going to reverse before too long here. Okay, last couple, CRWV here. While I do think CRWV can do more, I did get out of some of my position, actually not my spot, but I got out of my calls because there are just some subtle signs of weakness here on the daily. In terms of we made this high, but we didn't break the previous high at 155. And then we made a higher low, but then a lower high and now a lower low. So just a subtle shift in structure. And we came back up. We're seeing if we are going to get a rejection from this volume cluster. And I thought, you know what, just for the period we're in the market right now, it's better to de-risk a little bit. And there are some other semiconductor plays that I want to rotate profits into. If this does drop down, say in terms of just the larger trend, if this drops somewhere to 107 again and is able to bounce, even if we get to 117 to that next volume spike, I would still look at this for another play. But again, just wanted to take some risk off the table, clean my portfolio up a little bit today, and make sure it was balanced with not too much allocation to any one sector. Okay, Circle is another one where I took a little bit of risk off the table today. Again, just for similar reasons, I have a lot of crypto and crypto proxy and crypto adjacent exposure. And I realized I just have way too many contracts on this. And since we broke down on structure a little bit in the near term, I should definitely de-risk. Now on the 4-hour, our RSI is reset. We're mean reverted to the downside. So it might have not been the smartest time to sell, but I'm trusting the resistance right now. And it looked like we were breaking out from this overhead resistance, then had that hard rejection, which is similar to what we saw in HIMS and on QUBT. Whenever you see a breakout and then, or a setup for a breakout like that, and then a hard rejection, it's just telling you that it's going to take some time and it needs to consolidate. And now this overhead trend line is playing resistance again. We're just getting into the lower band and we broke these previous swing lows. I was still okay with these lows because they were slightly higher. So again, just following the rules of structure, even though the 4-hour is looking fairly oversold. But now if we don't break back into the center band on the 4-hour, this is most likely going to take a couple swings lower before it can recover again. And then, we can have another look at Circle to see if there are any setups that we want to pursue. And really, this breakout has not yet been invalidated for this falling wedge breakout and the price target to 200. This is just going to take a little bit more time than we initially anticipated. Okay, another one that challenged us with a breakout setup earlier this week, only to reject and now close back within the symmetrical triangle, and that is BBAI. And it really looked like we were targeting that $11.50 from the breakout. I'm still in calls from down here that are still in a profit. They're not doing as well as they were a couple of days ago, but I need to keep my eyes on this one to see if it's worth staying in or getting out of. If you look on the 4 hour, you can see that breakdown and then the resistance we found just underneath into the close. Mean reversion on the 4 hour is about to print a mean reversion dot. It can drop down a little bit more. So let's see what this does next week and if we can still get to some of those higher price targets. Okay, just coming back to one that we haven't talked about for a few months, and I'm not in it right now, but ATAI, we played this in the summer from about that $2 mark up to about $4.50 before we got out of it. And it has continued to perform. The psychedelic space has been doing well. Massive volume candle on the breakout today of the range. And I think with one like this, it's nice to just go to the weekly to see where we could anticipate resistance. The weekly RSI is getting overheated, and this has really outperformed. I thought this zone that we broke out from at $6.32, that this, well, I guess this low pivot here too, we did find a bit of resistance at 658, would be the toughest zone to get through. So let's see what this can do. It's starting to get volatile in terms of bigger candles, and usually that leads into some kind of blow-off move, but if you want to play the momentum for the breakout, be careful. Charts are overextended, but this could be one of those, like we've seen in other small cap names, where it just has some kind of crazy, move to end this run up, where there can be opportunities, but the risk is much higher. So please be careful. So that is it for the charts. Just a quick housekeeping note at the end. I have decided to cap the top tier of my Patreon. The thinking behind that is that I want the quant tier to be a very high touch environment where I can respond personally to every note, to every comment on a post, and really be active in that chat area and on our weekly calls. So there are about 40 seats left. If you are interested, I would of course love to see you in there. And once that fills up, the only seats that will be available is if anybody cancels their membership. Now, for the weekend ahead, let's keep an eye out for crypto over the weekend, as that will be a leading indicator for sentiment as we get into the market open on Sunday afternoon. If we do break down further, I'm really looking to that 95K to 98K area for Bitcoin as the next area of support. I'm not as concerned for Bitcoin because it has a lot further to go before getting into its major underside support and really breaking down structure. But if we're looking to Solana, if we break down from the current levels that we tested overnight Thursday going into Friday, that could really lead into something more serious. So watch out for that and for the altcoin space. Obviously, a bounce from the lows that we tested today would be the best sign of strength. That said, I am remaining optimistic, and I will see you all on Monday as we check in and look to the week ahead. Bye for now.